Did you notice this? Gold dropped, while everything else is getting unstable. That doesn't make sense until you see what central banks are doing. Gold, the asset that historically rises during uncertainty, is doing something very different this time. Instead of acting as a safe haven, it has started to fall sharply, even as geopolitical tensions remain elevated and inflation risks continue to build. And when something breaks from historical behavior like this, it usually means one thing: the underlying system is shifting. Today is April 4th, 2026, and the data coming out of global markets over the past few weeks is starting to paint a very unusual picture. Gold recently dropped nearly 12% from its peak levels in early 2026, despite ongoing geopolitical instability and rising oil prices, which would normally support higher gold prices. At the same time, silver has also shown sharp volatility, falling from previous highs after a massive rally in 2025, where it surged nearly 147% before correcting back toward lower levels. Now, at first glance, this may look like a normal correction. Markets go up, markets go down. But when you look deeper into what's happening behind the scenes, the picture becomes much more complex. Because this isn't just about price movement. This is about liquidity, monetary policy, and the behavior of the most powerful institutions in the financial system: central banks. For years, central banks across the world have been accumulating gold at record levels. According to data from the World Gold Council, central banks purchased around 863 tons of gold in 2025 alone, marking one of the strongest periods of accumulation in modern history. This trend has been driven by a broader shift in global financial strategy, a move toward diversification away from the US dollar, and a desire to hold assets that are not tied to any single government or currency system. Even the International Monetary Fund has highlighted how gold continues to serve as a key reserve asset, especially during periods of inflation, rising debt, and monetary uncertainty. And when you look at the bigger picture, it makes sense. Global debt levels are rising, monetary systems are under pressure, and trust in fiat currencies is being tested in ways we haven't seen in decades. But here's where things start to shift. Despite this long-term trend of accumulation, recent data shows that central bank gold buying has slowed significantly in early 2026. In January alone, net purchases dropped to just 5 tons, compared to a monthly average of around 27 tons throughout 2025. That's not just a minor fluctuation, that's a clear slowdown in momentum. And in some cases, it's not just slowing purchases, it's active selling. Countries facing economic pressure have started to liquidate portions of their gold reserves to manage liquidity needs. For example, reports indicate that nations like Turkey and Poland have sold gold reserves to stabilize their economies amid rising energy costs and fiscal stress. This is a critical point because when central banks sell gold, it's rarely about losing confidence in the asset itself. It's usually about something else: the need for immediate liquidity. Liquidity is one of the most important concepts in financial markets, and it's often misunderstood. In simple terms, liquidity refers to how easily assets can be converted into cash without significantly affecting their price. When economies are under stress, whether from inflation, currency depreciation, or external shocks, central banks need liquidity to stabilize their systems. And gold, despite being a long-term store of value, is also one of the most liquid reserve assets available. So when central banks start selling gold, it may not mean they believe gold is going down. It may mean they need cash right now. And that changes how we interpret what's happening. Because at the same time, global monetary conditions are tightening. Central banks like the Federal Reserve and the European Central Bank have signaled that interest rates may remain higher for longer, as inflation pressures have not fully subsided. This matters because gold, unlike bonds or savings instruments, does not generate yield. So when interest rates rise, the opportunity cost of holding gold increases, which can put downward pressure on its price. At the same time, The US dollar has strengthened in recent weeks, driven by higher yields and relative economic resilience. And historically, a stronger dollar tends to push gold prices lower because gold is priced in dollars globally. This creates a combination of forces that are all working against gold in the short term: higher interest rates, stronger currency, and tighter liquidity. Now, when you combine these factors together, you start to see why gold is behaving differently this time. It's not ignoring risk, it's reacting to a different kind of pressure, monetary pressure. And this is where things become even more interesting. Because while gold is facing short-term pressure, the long-term demand story has not disappeared. In fact, institutions like JP Morgan and Goldman Sachs still maintain a bullish outlook for gold over the long term, citing continued central bank demand, geopolitical uncertainty, and structural shifts in the global financial system. So what we are potentially seeing right now is not a collapse, but a transition, a shift between phases. And historically, these transition periods are where the most significant moves begin to form. Now let's bring silver into the picture, because this is where the story starts to take a different direction. Unlike gold, silver is not just a monetary metal. It also has strong industrial demand. It is used in solar panels, electronics, and a wide range of modern technologies. This means its price is influenced not only by financial markets, but also by real economic activity. And right now, that demand is still present. At the same time, supply constraints and previous speculative demand have created a volatile pricing environment. Silver surged dramatically in 2025, driven by both retail interest and physical market tightness, before correcting sharply in early 2026. But here's the key difference. Gold is primarily driven by central bank behavior and monetary policy. Silver is influenced by both monetary forces and industrial demand, which means when conditions shift, silver tends to move faster and often more aggressively. So now the question becomes, what happens next? If central banks are slowing their gold purchases, and in some cases selling for liquidity, while at the same time, global economic activity continues to drive industrial demand for silver, then we may be looking at a divergence, a moment where gold stabilizes while silver begins to build momentum. And historically, when silver starts to move after a consolidation phase, it doesn't move slowly, it accelerates. But here's the part that most people overlook. These moves don't begin when everything is obvious. They begin during uncertainty, during volatility, during moments where the market appears confused, moments like this, right now, before the next Federal Reserve decision, before the next inflation report, before the next shift in liquidity conditions. And that brings us to the real question. Is what we are seeing simply a temporary correction driven by interest rates and currency strength? Or is this the early stage of a much larger repositioning by central banks and institutional players? Because if liquidity pressures are forcing short-term selling, while long-term demand remains intact and industrial forces continue to support silver, then the next move may not follow the pattern most investors are expecting, and the timing of that move could matter more than the direction itself. Now, to really understand what's happening, you have to step back from gold itself and look at the system that controls everything around it, because gold is not moving in isolation. It is reacting to something much bigger, the global liquidity cycle. Liquidity is the lifeblood of financial markets. It determines how easily money flows between assets, countries, and institutions. And right now, that flow is tightening. Over the past few months, central banks, especially institutions like the Federal Reserve and the European Central Bank, have been signaling that interest rates may remain elevated longer than previously expected. This shift is not random. It is response to persistent inflation pressures, particularly those driven by energy markets and geopolitical disruptions. And when interest rates stay high, something very important happens. Money becomes expensive, credit tightens, liquidity begins to drain from the system. And when liquidity drains, assets that rely on easy money, including gold, can experience short-term pressure even if their long-term fundamentals remain intact. Now, this is where things start to connect at a deeper level, because gold doesn't just respond to inflation, it responds to real yields, the difference between interest rates and inflation. When real yields rise, gold often struggles. When they fall, gold tends to rally, and right now, yields are rising again. Bond markets are reacting to the possibility that central banks will not cut rates as quickly as expected. Investors are demanding higher returns to hold government debt, especially in an environment where inflation remains uncertain and global debt continues to expand. And that brings us to one of the most important pieces of this puzzle: global debt. According to multiple institutional estimates, total global debt has now exceeded $300 trillion, reaching levels that are multiple times larger than global GDP. This matters because high debt levels limit what central banks can do. If they keep rates high for too long, debt servicing costs rise, putting pressure on governments, corporations, and households. But if they cut rates too quickly, inflation could accelerate again. So central banks are stuck in a narrow path. And when central banks are constrained, markets become unstable. This is exactly the kind of environment where volatility increases, not because something has broken yet, but because the system is under tension. Now, this is where the role of institutions like the International Monetary Fund becomes critical. The IMF doesn't directly control markets, but it monitors global financial stability and provides guidance and support to countries facing liquidity crises. It has repeatedly emphasized the importance of maintaining reserves, managing currency risks, and preparing for potential shocks in the global financial system. And one of the key reserve assets that countries rely on is gold. But here's the paradox. Gold is both a safety asset and a source of emergency liquidity. And in times of stress, those two roles can conflict, because when a country needs immediate funding, whether to stabilize its currency, pay for energy imports, or manage fiscal deficits, it may need to convert assets into cash. And gold becomes one of the fastest ways to do that. This is why, historically, gold has sometimes fallen during the early stages of a crisis. Not because it loses value, but because it is being sold to generate liquidity. We saw a version of this dynamic during past financial stress periods, and we are seeing early signs of it again in 2026. In fact, recent market analysis suggests that part of the sharp sell-off in gold and silver earlier this year was driven not by a collapse in fundamentals, but by a liquidity event, where large positions were unwound due to margin pressures and capital constraints. This is a critical distinction, because it means the market is not necessarily rejecting gold. It is reacting to liquidity conditions, and liquidity can change quickly. Then what comes next may not follow the patterns most investors are expecting. To understand where this is heading, next, you have to look beyond interest rates, beyond inflation, and even beyond central banks themselves, and focus on the structure that holds the entire global financial system together. That structure is the US dollar system. Because at the end of the day, gold does not compete with stocks or bonds or even commodities. Gold competes with trust, and that trust is currently anchored in the dollar. For decades, the US dollar has been the dominant reserve currency. It is used in global trade, energy pricing, debt issuance, and international settlements. This gives the United States a unique advantage: the ability to issue debt in its own currency, while the rest of the world depends on it. But this system also creates pressure, because it forces other countries to hold dollar reserves, even when they may prefer diversification. This is one of the key reasons central banks have been accumulating gold over the past decade. It is not just about safety, it is about independence. It is about having an asset that is not tied to any single country's monetary policy. And after events like the freezing of foreign reserves in recent years, many central banks have started to rethink how much exposure they want to the dollar-based system. At the same time, data continues to show that central banks are still structurally positioned toward gold, even if short-term buying has slowed. In 2025 alone, Central banks added over 860 tons of gold to their reserves, continuing a long-term trend of accumulation despite rising prices. This suggests that the underlying strategy has not changed, only the pace has adjusted. Now here's where things become more complex. Because while central banks are diversifying away from the dollar in the long term, the global system is still heavily dependent on it in the short term. And that creates a tension, a very important one. Because when global liquidity tightens, like it is right now, demand for dollars actually increases. Countries need dollars to service debt, to pay for imports, and to stabilize their currencies. This can strengthen the dollar even in periods where long-term confidence in the system is being questioned. And when the dollar strengthens, gold often comes under pressure. This is one of the reasons why gold has not reacted in the way many expected during recent geopolitical tensions. It is not that the risk is absent, it is that the liquidity environment is dominating the reaction. Now layer this with another factor. Global trade dynamics are shifting. Countries are increasingly exploring alternatives to dollar-based settlement systems. Some are using bilateral trade agreements, others are increasing gold reserves, and some are experimenting with local currency settlements. This doesn't mean the dollar is collapsing, far from it, but it does mean that the system is evolving. And when systems evolve, transitions are rarely smooth. They happen in phases, they create friction, they create volatility. And they often create opportunities, but only for those who understand what phase the system is currently in. Right now, we appear to be in a phase where short-term liquidity pressures are overriding long-term strategic positioning. Central banks are still structurally interested in gold. Institutions are still projecting long-term strength. But in the short term, the system is demanding cash, and cash in the system means dollars. This is why you're seeing a divergence between narrative and price. The narrative says gold should rise. The conditions say liquidity must come first. And markets always respond to immediate conditions before long-term expectations. Now let's take this one step further, because if the current phase is defined by tight liquidity and a strong dollar, the next phase will likely be defined by the opposite. At some point, central banks may be forced to shift, not because they want to, but because they have to. If debt servicing costs continue to rise, if economic growth slows, if financial conditions tighten too much, then the pressure to ease policy increases. And when that happens, liquidity returns. Historically, when liquidity returns, gold tends to react quickly, but silver often reacts even faster. And this is where the setup becomes interesting. Because silver sits at the intersection of two systems, the monetary system and the industrial economy. If liquidity improves, monetary demand for silver increases. If industrial demand remains strong, that adds another layer of support. And when both forces align, silver has historically shown the ability to move sharply in a very short period of time. But that alignment does not happen when everything looks clear. It happens when the system is transitioning, when signals are mixed, when narratives conflict, moments like this. Now let's look at what institutions are actually signaling. Even as volatility increases, major financial institutions continue to maintain a constructive outlook on gold. Over the medium to long term, forecasts suggest that demand from central banks and investors could remain strong through 2026, with prices potentially moving higher if monetary conditions shift. At the same time, central bank surveys indicate that a significant majority still view gold as a critical reserve asset for diversification and risk management. So again, the long-term story has not changed. At this point, the most important question is no longer what is happening, but when things could change. Because markets do not move randomly, they move when specific conditions align. And right now, those conditions are slowly building beneath the surface. If you look closely at how financial cycles unfold, there is always a moment, a turning point where policy, liquidity, and market expectations collide. That moment is not announced. It is not obvious. It forms quietly, often during periods of confusion, just like the one we are in right now. One of the most important triggers to watch is the behavior of the Federal Reserve, because even though global markets are interconnected, the Federal Reserve still plays a central role in determining global liquidity conditions. When the Fed tightens policy, liquidity contracts not just in the United States, but across the entire global financial system. And when it eventually shifts direction, that liquidity can return just as quickly. Right now, the Federal Reserve is in a difficult position. Inflation has not fully stabilized, and energy prices continue to create uncertainty. At the same time, maintaining high interest rates puts increasing pressure on debt markets, corporate financing, and government budgets. This creates a balancing act, one that cannot continue indefinitely, because eventually something has to give. Historically, central banks do not pivot because conditions are perfect. They pivot because pressure builds to a point where maintaining the current policy becomes more risky than changing it. That pressure can come from multiple directions: slowing economic growth, stress in the banking system, rising default risks, or instability in bond markets. And there are already early signals forming. In recent months, analysts have pointed to growing concerns in sovereign debt markets, particularly in Europe, where increased government borrowing and higher yields are creating potential vulnerabilities within the financial system. This matters because sovereign debt is the foundation of the modern financial system. If confidence in that foundation begins to weaken, liquidity conditions can change very quickly. At the same time, there are signs that central banks are becoming more cautious in how they manage their reserves. Gold buying has slowed, not because the long-term strategy has changed, but because volatility and high prices have forced institutions to become more selective in their actions. This combination, tightening liquidity, rising debt pressure, and cautious institutional behavior, creates a setup where the next move is not driven by retail investors, but by policy decisions. Now here's where timing becomes critical, because markets do not wait for official announcements. They begin to price in expectations before those announcements happen. If investors begin to believe that central banks may eventually shift toward easing, even slightly, liquidity expectations start to change. Bond yields may stabilize, the dollar may stop strengthening, and assets that were under pressure begin to recover, not slowly, but suddenly, and often without warning. This is why the transition phase is so important, because once the shift becomes obvious, the opportunity is already reduced. Now let's connect this directly to gold and silver. If liquidity remains tight, gold may continue to experience pressure in the short term. That would not be unusual. It would be consistent with historical patterns where higher real yields and strong currency conditions suppress gold performance. But if liquidity conditions begin to ease, even marginally, gold has historically responded very quickly to that shift. And silver tends to amplify that move, because silver is not just reacting to monetary policy, it is also reacting to industrial demand and investor positioning. So when liquidity improves and risk sentiment begins to stabilize, silver often accelerates faster than gold. But again, this does not happen in a straight line. It happens through volatility, through false starts, through moments where the market appears to move in the opposite direction before reversing. And this is exactly why most investors miss it. They look for confirmation. They look for stability. They wait for the signal to become clear. But by the time it becomes clear, the move has already started. Now here's the deeper layer. Because even if central banks do not officially pivot immediately, markets often move ahead of them. Expectations drive price, not just actions. So the moment investors begin to believe that the tightening cycle is nearing its peak, the reaction can begin. And this is where positioning becomes critical, because during this phase, the difference between reacting and anticipating becomes very significant. Now let's take this one step further, because while everyone is focused on whether gold is going up or down, very few are asking the more important question: What is the system preparing for? Because central banks do not make decisions in isolation. They respond to pressure, they respond to risk, they respond to instability. And when multiple signals begin to align, their actions follow, sometimes quickly, sometimes aggressively. And when that happens, markets adjust, not based on past data, but based on future expectations. So what we are seeing right now is not just a price movement, it is a buildup, a compression of forces, liquidity pressure, debt pressure, policy constraints, market expectations, all moving closer together. And when those forces converge, the outcome is rarely quiet. At this stage, everything comes down to one simple but powerful idea. Markets are not reacting to what is happening today. They are positioning for what could happen next. And if you step back and look at the full picture, liquidity tightening, rising debt pressure, central banks adjusting their behavior, and precious metals moving in unexpected ways, it starts to feel less like a random correction and more like a system preparing for something. Because historically, the most important shifts in financial markets don't happen during stability, they happen during transition, during moments when the signals don't align perfectly, when gold falls even though risk is rising, when central banks are still buying but at a slower pace, when some institutions are accumulating while others are forced to sell. Right now, we're seeing exactly that kind of mixed environment. On one side, central banks continue to treat gold as a strategic reserve asset. In fact, data shows that global central banks added hundreds of tons of gold in 2025 and are still expected to remain net buyers in 2026, even if the pace moderates slightly. On the other side, short-term pressures are forcing certain countries to liquidate reserves. For example, recent reports confirm that Turkey reduced its gold reserves significantly, selling billions worth of gold to stabilize its economy amid rising geopolitical and energy-related pressures. So what you have is not a single trend, but two forces moving at the same time: long-term accumulation, short-term liquidation, and when these forces collide, markets become unstable. Now, layer on top of this the behavior we've already seen in 2026. Gold dropped around 11 to 12% in March, one of its sharpest monthly declines in decades, even as geopolitical tensions remained elevated. That alone should raise a question, because historically, gold rises during uncertainty. But this time, it didn't. And when an asset breaks its historical pattern, it usually means the underlying conditions have changed. Not permanently, but structurally, at least for this phase. Now here's where the real insight begins. Because this is not just about gold. This is about what gold represents. Gold is not just a commodity. It is a reflection of trust. Trust in currencies. Trust in central banks. Trust in the financial system itself. And when gold behaves differently, it often means that trust is being tested in a different way than before. Right now, that test is not coming from fear alone. It is coming from liquidity pressure, from debt, from policy constraints, from a system that is trying to balance too many forces at once. And that is why this moment matters. Because when systems are under pressure, they don't break immediately. They adjust, they stretch, they shift, until eventually something triggers the next phase. And the trigger does not need to be dramatic. It could be subtle. A change in central bank language, a shift in inflation data, a movement in bond yields, or a liquidity event somewhere in the system. But when it happens, markets will not wait. They will react, and they will reprice quickly. Now bring silver back into this picture, because silver is not just sitting quietly in the background, it is positioning. Right now, silver remains volatile, moving within a range, reacting to both monetary pressure and industrial demand. But historically, silver does not stay quiet forever. It waits, and then it moves. And when it moves, it tends to do so with speed, because unlike gold, which is heavily influenced by central banks and reserve strategies. Silver is influenced by both financial flows and real-world demand from industries like energy, technology, and manufacturing. So when liquidity conditions change, and when economic signals begin to align, silver often becomes one of the fastest moving assets in the market. Now think about that in the context of everything we've discussed. Liquidity is tight, central banks are constrained, debt is high, gold is under pressure, silver is consolidating, and expectations are beginning to shift. This is not a stable environment. This is a setup. And setups do not last forever. They resolve one way or another. Now here's the part most people overlook, because while everyone is focused on price, up or down, very few are focused on positioning. And positioning is what determines outcomes. Because by the time a move becomes obvious, the positioning has already been built by institutions, by central banks, by large players who are not reacting to headlines, but to underlying conditions. And this is why moments like this are so important, not because they are clear, but because they are unclear. Because uncertainty is where the biggest shifts begin. Now ask yourself this: if central banks continue to manage liquidity pressure, if the Federal Reserve eventually shifts its stance, if global debt forces policy adjustments, and if industrial demand for silver remains intact, then what happens when all of those forces begin to align? Because historically, that alignment does not lead to small moves. It leads to repricing across multiple asset classes. And precious metals are often at the center of that shift. Not always first, but often fastest once it begins. So the real question is not whether gold will recover or whether silver will move. The real question is timing, because timing determines everything. And timing is the one thing markets never make obvious. Which brings us back to where we started. Something is shifting. Right now, not loudly, not clearly, but quietly, beneath the surface. And if this shift continues, if liquidity conditions change, if policy begins to adjust, then the next move in gold and silver may not look like a continuation. It may look like a reset, a repricing, a phase change in how the system itself behaves. And by the time that becomes obvious, it may already be too late to react the way most people expect.